Good morning, everybody. Um, Thank you very much. I've had some great thoughts already this morning. And certainly, Gary, I think you've highlighted some of the challenges which I'll go through. And certainly, that's been a great intro, despite the fact that I knew nothing about your presentation. So that's really helpful. I've been asked to talk about why we've made a shift. So SpiceJet 2 years ago, or just over 2 years ago, was a low-cost carrier. We had 22 aircraft at the time. Really struggling to make money because India is pretty much the highest cost environment for LCCs around the world. And that's predominantly driven by the tax structures, particularly around fuel and around airports. Their public-private partnerships models have certainly created some issues. So I'll go through some of those and why we've sort of shifted from what was more of a cookie cutter type LCC model that quite frankly didn't work to actually something that's a little more sustainable and something that actually plays to the strengths that's in India and sort of plays with the gaps. So with LCCs, it's all about looking at the 80% of the model, which is a cookie cutter around the world, and then adapting the other 20% to suit your local market. If you just keep trying to reinforce the 100%, it's only a matter of time before you'll find that you're not actually suitable to the market that you're in. These are the three areas that I'll cover. So why the shift? Why did we decide to go from something which was a proven model to something where actually we started to add more complexity? The last thing that anybody needs in this industry is actually to add more complexity, but we didn't actually just do it by accident. We actually volunteered to do it. We added domestic regional routes, which again, everybody says, well, why did you do that? Why did you go for aeroplanes with these little propellers? You know, that's not really the low-cost model. Why are you doing that? And then look at the internationals. One would say, well, why do you need to do that? You're in a country of 1.3 billion people, sixth largest country on the planet, where only 56 million people actually travel by air every year. And if you compare that against China, where last year's volumes were 320 million, in a population which is pretty much identical, you can certainly see that there'd be a huge amount of gaps or theoretical opportunities within the domestic market. But what we have actually done and what we have actually delivered over the last 2 years is we've added 29 aircraft over a 2-year period of 2 different aircraft types. So we're now a 51 aircraft fleet carrying 12 million passengers a year and 330 flights a day. SpiceJet was exposed to some significant risks in 2008. What we had after the 2008 crisis is it certainly brought to everybody's attention how much the fuel price was distorted within India. Fuel price at the moment is running at around 50% beyond what you're actually paying in the rest of the world. So if you're paying on average about $110, $115, we're actually paying about $160 in equivalent terms. And that's driven by two things. That's driven by the tax regime, particularly within the States, that varies between 16 and 30% on fuel. But also there's a pricing mechanism which still treats jet fuel as an imported commodity, despite the fact that 50% of India's production of jet fuel is actually exported. So we're actually paying excise duty on a locally produced good, which is illogical, but you can keep beating your head and complaining about the system, but that is the system. So we had to try to work, okay, how do we actually move forward from there? And then when you try to pass that huge cost onto the consumer, quite frankly, wasn't having it. They couldn't afford it. It is a developing economy. The ability to spend at that level just wasn't there. So what really started to happen there was passengers just started to evaporate almost overnight. Growth was certainly outpacing the growth in infrastructure. That, to a certain degree, has corrected itself since 2008. Some of the airports that we now have in India are actually world-class, particularly Hyderabad, Bangalore, and Delhi. Some of the others have a bit more challenges, and Mumbai as a mainstream airport it's in a different world to the level of challenges we experience there. But the infrastructure is not quite the bottleneck that it was. But aircraft orders had to really be adapted to what actually worked for the market. But apart from fuel levels and fuel issues, particularly with ATF input, there's also exchange rate, which is a huge challenge. Um, the rupee exchange rate to the dollar actually reduced by 20% about 15 months ago. So we went from about 45, 46 to the dollar. We dropped to between 56, 57. And it pretty much stabilized around 55. So all of our dollar-denominated costs have gone up by 20% without us actually doing anything. Because obviously our revenue is all, or was principally local rupee based. So when we actually look at the strategic shift, we said, well, why do we need to do this? Why do we need to look at something different? Well, just carrying on with the old model wasn't going to work. All that would happen, as Gary said, is that we would have just landed up compounding the size of losses that were there, because you cannot pass on the high cost of operation in a growing market to the consumer that can't afford to pay. So we actually looked at changing the business model. So we actually started looking at adding turboprops and actually say, well, why would we want to do this? Well, there's a regional aircraft policy in India, which was around 4% tax rate. As I said before, it was before 16 to 30 on narrow-body aircraft. But turboprops, anything less than 80 seats or 30 tons, are a fixed price or fixed tax at 4%. That changes that bit totally. But also look at it as a low-cost aircraft. So actually use it not on a hub-and-spoke type model, but actually on a pure point-to-point. And that really goes into the infrastructure issues that are actually there in India. And the value of the two actually side by side could actually really make sense for us. So what we actually decided to do was we introduced the domestic regional services with the Q400. So last year when I was here, it was really just something we'd started playing with, I suppose is the best description. We'd only really just started it. Now for us, it's a significant part of our business. This really supplements the mainline domestic and international operation. So not only is there natural feed, because we do a huge amount of our own self-handling, we self-handle at 41 of our 43 domestic airports. So actually connecting passengers doesn't really cost me any money because they're existing staff. We don't actually have additional manpower to facilitate connections. But it's certainly the GDP growth that's actually happening in tier 2, tier 3 cities across India is actually higher than in the metros. You're looking at around 10 to 15% growth there, rather than the 5-6% average growth which you're seeing across India. And across the 65, there are 65 airports in India that can only be served by turboprops. If you look at this map, it's particularly full and actually particularly indistinct up there. But it really just shows a map of India and a lot of places that can only be served by turboprops. The government policy particularly is developing new and smaller airports. That's particularly driven by, politically, you get a lot of votes from small communities. So they're really trying to develop small airports to say, well, I brought this here. Now, that's not something we discourage, because the more of those sort of airports that open up, there are a lot of these opportunities growing at 10 to 15%. So we're trying to certainly encourage that sort of thing. On the Q400, though, what we had is that we shifted a significant portion of demand risk on the mainline onto a different market segment. Had we just pumped in more and more 737 capacity onto these markets, all that would have happened is load factors would have continued to dip and costs would have continued to rise. So we're allowed to size some of the markets by seasonality. We don't do that very much, about 10% of the capacity. If you look at, say, a small route between Chennai and Goa, in the summertime, that makes a lot of sense to fly a 737 on that. But in the winter, it just can't be supported. But to actually keep that market going, we actually switched the two aircraft types. That wasn't really one of the reasons we did this. It's almost an ancillary benefit, which we hadn't expected, but certainly helps us to be able to do that. And we allowed for the deployment of the 737s and actually focus those on the bigger routes, rather than doing some of the obligation routes which the government would like us to do. So it's one of the countries where you get nudged in the direction of certain routes by certain politicians. Now we can actually accept that nudge with a much smaller aircraft, which is actually much low risk. And we're also looking at even the Q400s are now actually flying on some of the shorter international routes. So we now fly from the south of India, from Madurai to Colombo, and also from Cochin to Male, with the Q400s as well. So again, that wasn't something in the original model, but to actually take these to the next step, these routes will probably not support a 737 in the short term, and we'll see whether that actually works flying them on the queues. If it works really well on the queues, then we can always put a 737 on tomorrow on these routes. These are easily capable airports of supporting 73s. And the lower acquisition model, or the lower cost acquisition, which we actually did with the Export Credit of Canada support, these aircraft have actually joined the fleet at a very low cost. So for us, we need to fly them about 8 sectors a day to actually make sense. We're currently the highest utilization operator of the Q400 per aircraft per day in the world. The next highest utilization operator of the Q4 is Horizon Air in the US, and they fly about 1.5 hours a day less per aircraft than we do now. So it's been a very successful deployment for us. It's actually worked. We sweat the asset, make sure that actually has certainly worked for us. So this is the actual network that we have now across India. And as you will see, it's geographically very diverse. We have 3 Q400 bases in Hyderabad in the center of the country, in Chennai, and up in Delhi in the north. And the number of destinations that we're actually serving is 32 now with the Q400s, with 3 bases, and we're now at 110 flights a day on this fleet alone. So a third of our daily flights have actually moved onto this aircraft type within 2 years. In fact, we're now just crossed 15 months of operation. We started in September 2011. And then on international. So why have we started to focus on international, and why have we pushed it so much? Well, there's 2 reasons for that. As I said before, the domestic operations on mainstream, particularly metro to metro, the cost base was incredibly high because of the high levels of taxation. And the exchange rate was certainly becoming weak. So what you had was principally dollar-denominated costs, artificially inflated using the taxation. But what you also had is that local revenue was in rupees, which was on a particularly competitive marketplace. You were really struggling to make the two actually work. And passing that full cost on to the passengers really did start to impact supply, or impact demand rather. This year is actually the first year where we've actually managed to pass that cost on to the consumer. And there's been a lot of pushback on from the consumers. The average fares now are actually much higher than I'd like them to be on the domestic mainstream operations. There's not much we can do about that. We're just pushing on the cost. We've actually just recently announced a quarterly profit of $20 million, 102 crores, which is actually the first time in 4 quarters we've managed to, well, the first time that we've been break even for the year so far in 2 years. So the change around is certainly starting to show some returns at this point. The international operation certainly insulates us from the cost structures that we have, the problems with the exchange rate, etc. And it also moves us the risks to a different product segment. So if you think of it from a business school model, we had a single tier structure where that tier was particularly weak. We had high cost issues, revenue issues weren't matching costs, and to put more and more growth in there, and to use Gary's thing, the aerosexuals, I could easily have said, no, well, we'll just pump another 4 aircraft into the air a year or 10 aircraft a year, and at some point, hopefully it'll get okay. In India, has a terrible tendency for throwing more and more volume into the market and actually not necessarily looking at bottom line return. But as an accountant, I just can't do that. So I have to start thinking, well, no, hang on. I can't keep getting money from shareholders if I'm never giving them anything back. So I need to give them some sort of return. The domestic passengers are also appreciating, particularly the brand that we've built up domestically is very good. So actually leveraging that and extending that into the international market has certainly helped us. And the route development that we've actually done will also be what absorbs our future growth capacity in the next 2 years. So we're still growing. We're still actually growing in the domestic metro to metro, but in the last 12 months, we've only grown by 7% on the metro to metro routes. Majority of our growth has actually come from our regional and international. On regional, we've grown by 180%, but on international, it's 189%. So that is actually the side of our business that's growing considerably. albeit that both of those were from relatively low bases, but they're fairly large now. So we're using this to increase utilization of the domestic 737 operation. So quite a bit of our internationals actually fly on aircraft that fly domestically. So we're actually using them for night flying. Nobody will fly domestically in India after about 11 o'clock at night. But everybody seems quite happy to come to the airport at 2 o'clock in the morning to fly international. So we shouldn't push that away. Having been in Dubai, which is where everybody seems to go to the airport at 2 o'clock in the morning, I thought that that's more than possible. So we certainly push that in India, and that's where a lot of our capacity is coming from for the internationals. What we've also started to look at is we're not actually flying what I call Me Too routes. So everybody would look at routes to say, well, everybody else is going there. Well, me too. So you end up with 6, 7, 8 competitors on the same routes, particularly like a Delhi, Singapore or a Mumbai, Singapore. Where actually, when you just look at the numbers, you say, well, the fares that are available in the market now, even if I sold 80% of my capacity at that price, I still wouldn't make any money. So better I don't bother with that at all. So we've gone for the slightly less of the Me Too routes. So the ones in black are the ones that we're actually serving today. So we serve Kabul, Kathmandu, Colombo, Male, Riyadh, and Dubai. So Dubai is actually served from 4 different points in India. Riyadh has only just gone live on the 4th of January. And actually, I flew in this last night from Guangzhou, where we actually did our launch. We actually do a Delhi Guangzhou will actually start on the 8th of February. So our spread will actually be all the way from Riyadh to Guangzhou, which is pretty much the extent of how far I can stretch the 737s. If I try to stretch them much further, we're probably going to have some unscheduled stops somewhere in between. So this is probably geographically as far as I can stretch them. And we can serve a lot of these points from numerous points in India. But we were actually running the regulatory process in Saudi Arabia, China, and of course India being our home base all at the same time, which has been a huge amount of complexity, which we have managed, and that will be where we continue to grow. The airports that we've actually listed in red are those that we have permissions for now, which is the first time that for the Indian carriers have been given permissions a year in advance. So before you had to apply for every route, and I can remember actually getting some permissions on the 27th of March for a summer schedule route, which meant that I could probably fly it by June if I was lucky. Now we actually know a year in advance, which is now why we're rolling all of these out quite so aggressively. So this is what our network looks like now. Again, the slide it's getting a little bit too complicated, but from where we actually started, where the network was actually very simple, it was 22 network points, 20 of them domestic and 2 of them international. We're now at 50 network points, 43 domestic, 7 international, which are live today or will be live in the next week, including Guangzhou. And over the next 12 months or so, we will continue to grow, particularly the international footprint, but also the regional footprint. So this 11% that you see here of our revenue share is actually based on 12 aircraft. We took 3 more aircraft in December, so we'll be able to grow that. Our plan is to grow our international share to about 20% and the regional market to around 20% of our revenue as well. That'll give us a good balance versus the cost base that we have, and it'll make sure that we don't have all our eggs in one basket, particularly a basket that looked like it was pretty weak when we were looking at it 2 years ago. So I won't take up any more of your time or bore you anymore with PowerPoint. Thank you very much.